Hello, welcome back, guys. So, Walgreens has been severely affected by its recent earnings report. It seems like it's down about 7%. It was down actually 7% yesterday. We'll see whether that trend continues, but they actually beat on earnings. It looks like it's mostly about what's going to be happening in the upcoming quarters that really messes with the Walgreens and their stock price. Yet, Walgreens is an interesting opportunity because it is a healthcare retailer. It's a pharmaceutical company, really, and a retailer that's selling drugs, prescriptions, and things of that sort. And so, even if we enter a recessionary phase, this kind of company is not going to decline a lot. Sometimes, maybe even not at all, because food, apparel, pharmaceuticals, medicine, things of that sort is what people actually need, and this is where they are going to be spending their money first. And so this kind of company could be an interesting hold, especially if it's cheap, and we really need to understand and examine it. Now, if you take a look at the 5-year chart for this one, you will see that it has been going down even at good times. And so again, if we're entering a lower phase, if we're entering a recessionary phase, it may be an interesting opportunity here. Now, let's take a look at what happened with Walgreens, and you will see here that Walgreens profit squeezed as COVID vaccine wanes, healthcare investment rises. Here is what we're seeing. Now, on Thursday, basically yesterday, they said its quarterly sales declined and profits got hit by waning COVID-19 vaccination demand. As you can expect, less people are actually getting vaccinated right now as we're exiting, hopefully, the pandemic phase. And the sales actually went down yesterday. Now, the drugstore chain stood by its full year forecast, saying it expects adjusted earnings per share to grow by the low single digits. That's we're going to be taking into account when we're going to examine it with our tool here, with our DCF model. And so they are expecting pretty much low single digits full year, basically for the full year, maybe 7%, 8%, maybe something of that sort, or even lower. And it pointed to rebounding store traffic and more online traffic here. And as you will see, again, they are mentioning things about the inflation here. The fact that there is a shift in calculus due to food and fuel inflation. Food and fuel in the US right now is skyrocketing, and this definitely plays a big role in what is happening with the stock market. But as you can understand, health and wellness will always be a priority. That makes a ton of sense. Now, the company actually beat on earnings, as I mentioned earlier, 96 cents adjusted versus 92, and a revenue of 32.6 versus 32.06 here. Interesting to notice that net income actually fell this quarter to 289 million, but there is a reason for that. This reflects a 683 million charge related to its opioid settlement with the state of Florida. So this is something that wouldn't worry me, this kind of decline in terms of revenue or in terms of net income, because it makes sense. It's something that had to be settled and is a one-off thing, so it doesn't really worry me at all here. Now, sales decreased to 32.6 billion. Of course, this is not great, from 34.03. But again, is what Walgreens mentioned here. They had increased sales during the pandemic, as you can understand. COVID vaccines, COVID tests, then this demand is waning and seems to be fading. Makes a ton of sense, and you could kind of expect this outcome. And of course, there will be some challenges, but Walgreens has also expanded online options, as you'll see, such as curbside pickup and delivery. I don't remember that being the case when I was living in the US for Walgreens. May have been. But to try to keep customers from buying toothpaste, soap, and other items from online players like Amazon, so it looks like they're trying to kind of put a stop on this and maybe have their own competition around this one. Interesting to see as well. Now, in the US and the UK, sales in stores picked up as consumers got out and about again. As you'll see, same-store sales for retail in the US, which includes front-of-store items like shampoo, toothpaste, and more, rose 2.4% excluding tobacco. Very interesting things to see, and Walgreens is down to about 22% so far this year. If we take a look at our tool, you will see that if you take a look at the 1 year, which includes more than this year, of course, it's actually almost 30%, 31% down. Now, let's take a look at the financials. 5 and 7.8 in terms of the price to free cash flow here. 5 for a PE and 7.8 to a price to free cash flow, which is nice to see and looks cheap really. And the company has been buying shares back as well, 12.8% decline here in their outstanding shares count, which is great to see because it means that we are now having less shares, we are more of an owner really, so our shares get more value when this happens. Looks like the company has quite some debt here. We will examine that compared to the free cash flow, or I should say total liabilities really. And it's noteworthy that the net income, free cash flow, and total equity is going down instead of going up. It's only the revenue that is going higher, but not significantly higher. So that may be a little bit worrying, of course. Now, a price to sales ratio that's very low here, but the margins are low. Return on equity is rather good. And again, looks like the company may be having a little bit of extra debt. Now, the thing that I love to see here, a dividend yield that the last 12 months has been about 5%. And the payout ratio is 40 in terms of free cash flow and 30 in terms of net income, which is great. It's very easily serviceable here from the company. Now, if you take a look at the dividends chart here, you will see that it has been increasing pretty much every year. And right now, the effective dividend yield based on the current price is 5%. And so this is a very, very nice dividend to get actually out of this company. And it looks like it could be safe, at least for a while here for the upcoming years. So for this reason alone, it could be a very interesting opportunity if you are looking to get a little bit of an income here, a little bit of a steady income coming your way every 3 months or so. So let's examine what is actually happening with our financials here, the financial statements. Now, the revenue has been growing a little bit, but not tremendously as you will see. However, this company was big already, huge already, from 118 to 132 billion here. And net income has been going down, and this is obviously a reason for concern. It hasn't been growing, it has actually been declining. And again, this can be a reason for concern here. EBITDA margins, as you will see, have been declining a little bit as well. So it looks like the company doesn't really achieve that much of profitability as in the previous years here. So again, this can be a little bit concerning, especially when the gross profit hasn't been moving too much here. Now, the balance sheet of the company is noteworthy here because you will see that total equity has been going down. So from 28 billion to 23.8 over here, and the total liabilities have grown from 37 billion to 57 over here, and they used to be 66. So it looks like they may be looking to reduce their total liabilities a little bit. Yet it's interesting to notice that the total debt has been increasing. Remember, the total liabilities are not only about the debt, it's also, for example, about suppliers. And the debt here has been increasing, and that's something that you obviously not really like to see that much. And we are looking at 57 billion in terms of total liabilities, yet the cash flow that the company generates has been about 4. And so this is a big disparity. There's a lot of total liabilities compared to the cash flow that the company generates, and that's a little bit dangerous. And it needs to be taken into account. Now, you can actually examine that towards the debt, and in this case you could be much closer. You would be at about a 6 or so. But if you take a look at the actual total liabilities of the company, then it becomes a little bit more worrisome here. Okay, now the cash flow statement here, from 4 billion for a net income, it has been going down again to 2.5, and this means that the cash from operating activities will also go down in a similar manner here. And you will see that it's about 5.5 here, not too many capital expenditures. That leads to about 4.1 billion, 4.2 in terms of free cash flow here. And they're paying 1.6 in dividends. That's about, like 3%, 20 to 30%, 25 to 30%, something of that sort. Net cash from financing activities minus 9 billion because the company has been paying back debt. We kind of saw that already. They are paying back some debt, but they are incurring quite some too. Okay. So let's take a look at the actual stock evaluation tool here. And while this is going down, is it an interesting opportunity at 38 bucks right now? Let's see. Now we're going to go with low revenue growth because we know that this is going to be the norm. So we're going to go very low, 0, 1, and 2. And this kind of matches the averages. And last year it was actually even negative. I don't think it will continue being negative, of course, but it could be an average of 0, 1, or 2. Very easily, especially in the upcoming 5 years. Net income margins are pretty low here. We're gonna go, let's just go 1.5, 2, and 2.5. The free cash flow margin that we're going to use has been all over the place for this company. A lot of ups and downs here, and yeah, this is probably something around maybe 100, 100 and 110, 120 is looking more than normal here for the company. They seem to be achieving more free cash flow compared to the net income that they generate here. So overall, it seems to be a little bit more. So yeah, 100, 110 and 120 makes sense. An annual return of 13% is what we typically go for. Let's hit calculate. What are we getting out of this one? Yeah, we're at the point where our medium and high estimates are already fulfilled. Now, to be sincere, I'd love to get it at a lower price. It is not a bad price though. And remember that this is just a 1% return that I have calculated for here. Now, yeah, in the last 3 years it has been 0.3, but it has been deeply affected by the pandemic decline. And so I would say that the average for this company would probably be about 2 to 3, maybe 2, more than, it's actually better one to say 1 to 2, 1 to 2.5, maybe 3, maybe a little bit of a stretch. But 1 or 2% I think makes sense, and we use 1 here. So I see this medium as a very normal state here. And remember, the company makes about 5% in dividend income, so that would be a nice income to have, and it seems to be rather safe here based on what the company generates. And also, it is safe even as the company produced less free cash flow than what they have been doing, for example, in 2018 or 2017. And it could have declined a little bit. Now, it could still go down a little bit more, of course, as we are exiting the pandemic and there's gonna be less sales of like COVID tests and things of that sort. Yet I feel that overall, buying this company is not a bad idea really, even at this current price, because again, it can generate some long income for many years. Of course, I'd like a better price. It could happen. I think it's likely to happen even. But if it reaches, for example, $30, then it becomes a much more interesting opportunity in my eyes, and this is where I would be looking to buy, frankly. Near $30, I think it would be a tremendous value for this kind of company, really. Tell me what you think about this one. Let me know by leaving a comment below, and thank you for watching. Remember to leave a like and subscribe if you're not a subscriber. Tons of content coming your way, more companies that I'm gonna be examining. And thanks for watching again. I'll see you soon. Bye bye.